Today's cardinal lesson, we're talking about the dreaded Irmaa, I-R-M-A-A. People, what in the world is that? Well, for starters, I'm just going to give you the classic definition. It's income-related monthly adjustment amount. Probably didn't do you much good. What in the world is that? It's the Medicare tax for people that Medicare calls a high income, or for the wealthy, or for people that have a substantial amount of income in retirement. They're going to make you pay more for your Medicare. It's just that simple. And so what I'm going to do today is just inform you about the whole program, and just so you understand what it is. And then in the second part of the thing, we're going to talk about what are some of the things you can do about it. So Irmaa is just another acronym that people throw around, and I'm sure that I've been the guy who informs people of this for the first time my whole career. This has been around a lot of years, and you just don't learn anything about it when you're signing up for Medicare, and then you get that letter in the second or third month of the start of Medicare, and then you get a repeat of the letter every January where it says, okay, so this year you're going to be paying X amount for Medicare Part B and Medicare Part D for the drug plan because your income 2 years ago was this amount. So they don't even make it easy. Again, what I want to do today is inform you, not try to make you like this. I just want you to understand it, and that it's not going to sneak up on you in retirement. So they got another acronym in here, which is called MAGI, M-A-G-I. And I find that kind of funny as well. I mean, it's just, you throw all these acronyms: modified adjusted gross income. So, you know, in the beginning there was income for calculating tax. And then there was gross income. So I guess that would be the money, your income before your deductions, the gross income. Then we had adjusted gross income, which is some sort of an adjustment on your gross income that would be used to drive a lot of other taxes. And now for the Medicare people, we have modified adjusted gross income, MAGI. Isn't that a blast? So we're not going to get in on this video to what all the elements of MAGI are, but for most purposes, it's just your adjusted gross income. It's how much money as a single person you earn, or as a married couple, and how you're filing. And anybody that's below $91,000 of modified adjusted gross income, is they're filing alone, they're not facing this. And couples that are below 182,000, they're not facing it either. So you might be listening and you say, well, that doesn't apply to me, I can go on. Well, if that's what you choose to do. But I've had many people that describe themselves as low income, or we really don't have enough to get by on, describe themselves as that way, and yet they're going to lay down an Irmaa letter to me. And let me tell you how that happens is many times the only real savings that a lot of people that have lower income have is a retirement account. And so a lot of them will go, and if they had a retirement plan and their employer bought them out of it. I've got several instances of this where I come in later where the people went to the retirement plan, they made them an offer for a cash buyout. They took it and they said, well, we got to make the check out to you. And so the people took it, and then all of a sudden they've got $180,000 added to their normal income. You know, if it's a single person, it throws them in, and then 2 years later, or really 3 years later, they find out about Irmaa on this mistake, as if they hadn't already suffered enough. So there's some things we can do about mistakes in the Irmaa, or if you have a significant reduction in income, like you retired, which a lot of people do at 65 or later, or if they don't retire at 65, they keep their group insurance, delay Medicare, and then retire at 68, and then they're coming off their group insurance, signing up for Medicare, and then all of a sudden they get this Irmaa letter. So when they come into us for financial planning or to buy their Medicare supplement, and they're coming in and they're doing it. We show them all this, but we're just us. I mean, there's a lot of people that are finding out from us for the very first time. So hopefully through this video and some education, I can get the word out about this more, and that there are things we can do about it. So it starts at $91,000 for single people. It starts at $182,000 for married couples filing jointly. It's going to use, like in 2022, these are new numbers. So if you studied this a year or two ago, you can look at this. If this is now 2022 that you're watching it, these are the numbers that affect this year. And where they're getting these income numbers is from your 2020 tax return. So you could have a situation, and I have many like this, where somebody that retired just right now or last year or the end of the year, they're turning 65, they're going on Medicare, and their post-retirement income is maybe going to be $60,000, $80,000, $90,000 a year. I mean, we're planning that for them, but yet their income 2 years ago, while they were working, or both of them were working, was up, at $250,000 or $300,000 by the time they threw it all together. And so they're looking at paying some pretty significant IRMA, and they think that, well, we're going to have to pay that now for a couple, 3 years till we, retire out of this 2 years ago thing. And I'm going to talk to you in a minute about what we can do about that. We can file an appeal. Now, and it's a graduated tax, and it is based upon the threshold, and it's a fixed amount that you get hit for the whole year based upon going $1 over the thing. So it's the cliff approach of taxing. So, if you made $142,010 and you were single, you'd go into this bracket, and it would make a difference of $100 a month in IRMA for the whole year. So, not that you can do anything about your 2020 income now in 2022, but that's how the system works. Now, another thing I want to point out is in a lot of our financial planning, people don't think, especially people that have significant money that they've accumulated and they're coming to us and we're helping them to retire and create income, they don't think a lot about one of them is going to be the surviving spouse. And a lot of times they don't really want to talk about that. But one of them has the chance of going maybe in their 70s or their early 80s, and then the other one lives on for another 10 or 15, 20 years. And what I've just kind of learned through doing this planning is that's something you need to plan for. And when I point this out to people, they generally become very concerned because they love their spouse and they want to make sure their spouse is well taken care of. And then the other side of that is it might be them. And what happens when you were a couple filing taxes together and then you are widowed or a widower, you are now thrust into the single tax bracket. So IRMA goes up, and then your taxes are going to go up based upon the same income. They're going to go way up because you'll be a single filer. So that's something we plan for in our financial planning. But now back to IRMA. This thing becomes pretty significant for people that are making $300,000-$400,000 a year, whether it's as a couple or a single person. And you get up to where we've got these numbers two ways, that the black number, $544.30 a month, is how much you'll pay for your Medicare Part B, but everybody pays $170.10. So the extra IRMA portion is $374.20, and then the amount of the Medicare Part D is $71. So you're paying an extra $440 a month, and that's on each of you, if you're husband and wife on Medicare. So it's a pretty significant amount. Now, sometimes people get so carried away, this angers them so much, they start shifting all their thinking in their financial planning, trying to reduce this thing. And my answer to that is, let's do some planning and let's be smart about this, but let's not let the IRMA tail of the dog wag, the whole dog. So, and I got to add one other joke, is that we've done some cartoons where you know, it's Uncle Sam who's the tax man and we want you, and then this is the female version, it's Aunt Irma. So take that for what it's worth. Now I want to talk about some planning things, and the first thing I talked about earlier was the appeal. Okay, so if you have a life event, which is typically retirement, so you have a reason that your income went down significantly, but you could also have a reduction in hours, so you didn't retire, but you just are going to be making less because you are working less, or you could have taken another job. So you don't necessarily have to retire. If you have a significant loss in income and you've had one of these life events, that's a justification for an appeal. And it's been my experience that people that appeal this on their own, they go into way too much depth. And so I would suggest my help or somebody like me to help you with the thing. I mean, you have to do the appeal. We can't do it for you, but we can certainly write it for you and let you put it in your own words. And we've got a pretty good batting average because we can tell you whether they're going to work or not, and then, or pretty much, and then, you know, we're going to have you give them exactly what they need, and we've got a good batting average on it. So the one thing we got is the opportunity for an appeal. Then the other thing is you can't really appeal a high income. Is if you've been successful enough and smart enough about your savings that you just have a high income in retirement. Now, those are exactly the kind of people that we can help doing all kinds of planning, not just Irma planning, to try to lower their tax bill and to try to be smart about it and do their estate taxes and all that type of planning. Well, Irma is just part of it. Now, one area that drives up income are distributions from an IRA. I mean, it's a significant area. Is a lot of people, even people with significant assets, a good percentage of those are in pre-tax money. And that's one of the big problems that we deal with when we're doing financial planning for people. And they're already aware of the problem is they got this big hunk of money and now they got to live on it for an uncertain number of years for retirement with a lot of uncertainties. And then the big certainty in there is taxes, and then there's a smart way to distribute that money, and we find that so that we can level it out. It's usually in small chunks. Okay, but then you reach a point at age 72 where you have to do this thing called RMDs. There's another acronym, Required Minimum Distributions. And most people are aware of those. And if they're going on Medicare, it's still 7 years off if they're 65 or a few years off, but they come up pretty quick and they are going to add to the Irma problem because it's just like you've got to take this amount out of your pre-tax IRA every year. The amount goes up a little bit every year, at least the percentage does, and that's going to add to your income and add to your Irma problem. So one thing that we could do is we could start taking distributions before 72 to lessen the effect of RMDs. We can start doing Roth conversions, which many folks are very interested in already. But then the problem with Roth conversions, if we're doing them after Medicare starts at like 65, we're actually increasing, because you do a $100,000 Roth conversion in 2022, your MAGI, or your modified adjusted gross income, is up by $100,000. So we're actually creating Irma to have the money over in a Roth. So all these things, we got a lot of plates spinning in the air when we're doing retirement planning, and Irma is just one of them, and it's actually a smallish plate, but it's still a consideration. And what I like about Roth conversions and Roth income is that it's tax-free. So it's not, when you ultimately start taking some money out of the Roth, you're not going to be increasing Irma, you're not going to be paying extra tax on your Social Security, or if you just leave it in the Roth and will it to your next generation, you're not paying any taxes on it, and it's not driving any income for me, and you don't have any RMDs. So that's about all I got today. I'm Hans Scheil, and I thank you very much for listening.